Matching that asset allocation to life stage. When you're younger, take on more concentration risk. Just invest in the US if you want. Don't really recommend doing completely that. Invest just in the semiconductor space. Again, be careful. You have time to take on that risk, time for large swings, but especially as you get closer to retirement, you need more diversification. You need more predictable returns.
Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor Mark Struthers takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for healthier, a wealthier, and a happier retirement.
Welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers, and I am super glad that you're here. Hope your Thanksgiving was good. Hopefully seeing family was good. I know it can be a stressful time of year. Recently, Nvidia came out with earnings, and Bloomberg reached out. Charlie Wells at Bloomberg reached out. I often work with him. His articles and newsletter are fantastic. His new book is really good. As a Gen Xer, his book about millennials hit home, but we're not going to talk about that today, even though we could, and maybe we should. Charlie reached out about Nvidia, and their earnings recently happened, but it had to do with FOMO. So Nvidia makes up a big chunk of your normal indexes. And some people, it's hard not to own Nvidia, but some people don't, or some people feel like they should own more because Nvidia has done so well. It's part of the AI trade. His article had to do with FOMO, fear of missing out. And it's a very human urge. A lot of times I think we're a little hesitant not to admit that we have FOMO. It's natural. And I want to talk about that today, especially for those that are close to or in retirement. First, as I mentioned, FOMO is normal. Let's just acknowledge it. I think you're doing more harm than good a lot of times to ignore natural feelings. FOMO is normal. It's human. When you see a stock like Nvidia rise dramatically, it's completely natural to think, did I miss something? Should I have bought more? Did others see what I didn't? Was just such a common sense thing? That is not irrational. That's emotional wiring. Our brains were built for survival, not the stock market. So first acknowledge that when you get these keep up with the Joneses, the fear of missing out, especially when it comes to something like saving, investing money in retirement, perfectly natural. The problem with reaction-based investing is that emotions are short-term. Investing needs to be thought of more in long-term cases. When we invest based on excitement or envy or regret, those are emotional decisions, not rational ones. One thing I mentioned to Charlie in the Bloomberg article was the risk of concentration. And that's kind of what we're running into here. It depends on where you're at life. If you're 20 or 30 years from retirement, you have human capital, income coming in, and you have time to recover. If you have 5, 10, 20, 30, 40, 50%, 60% of your portfolio in one company or even one sector, that can be pretty dangerous. And with great concentration can come great wealth, but also great concentration can destroy wealth quickly. Whenever I use that saying, I always think of that Spider-Man, with great power comes great responsibility. And maybe it applies with great concentration becomes great responsibility. I'm not sure if that works or not. But if you're close to retirement or taking money out of your portfolio, you simply don't have the time to recover if it drops. And more importantly, and that's what I mentioned in the article, but one thing that I didn't mention was that even if you do have time, technically have time, even if you have the resources to weather kind of a worst case one stock or one sector extended drop, most people in retirement don't want to go through that because you're dealing with unknowns. You're more vulnerable. So a lot of times folks when they go into retirement, it's that the psychological part, the emotional part. So not having that runway, not having that human capital, even if you technically have the assets versus spending and all these other things to say, yeah, you could. The CFA in me, the spreadsheet analyst guy in me says, yeah, based on all the numbers, you could still take on the risk, even though you're not 20 or 30 years younger. But most people don't want to. They don't want to endure that. I would say even most people who think they would at 65 or 70 or 75, when they actually get there, they don't. Some do. Bottom line is, your time horizon will often dictate how much concentration risk you should probably be taking on. You don't have the same time to recover if it drops. You often aren't in the same emotional, mental place to deal with the recovery time, to deal with the drop. I didn't mention this to Charlie Bloomberg, but as I was prepping for this recording, one thing that occurred to me, and it's even in my book, it was a COVID book, so I'm not going to, the book is decent. It's a short read. It's certainly worth, I think, the money. But that being said, if you do read it, be kind. It was a COVID book when things kind of came to a halt. But in this book, I talk about diversification, and I make an analogy, a marathon analogy. My son just ran his first marathon, the Twin Cities Marathon. He was scheduled to do his first one at 15, but then COVID hit. But watching him complete it, and compete, kind of gave me a fresh perspective again on the role of diversification, harking back to the one I used in my book. And I think I even pulled some data from different races. And some of you who might be familiar with me could probably see where I'm going with this. Predicting the performance of one runner is extremely difficult. And I've done that with myself. I've done that with my son. There's a bunch of folks who are really hardcore runners in the local run group. I follow them when they often go off and do Boston Marathon or New York or something. And even many of them would be, but no matter how, some of them work in shoe stores. Some of them, again, these are people who live and breathe running. And even though this is many ways what they do, or a big part of what they do, they can have a bad day. And stomach issues is one that seems to pop up a lot. So predicting the performance of one runner is tough. Could get cramps, hydration, bad sleep, got in a fight with their girlfriend, boyfriend, wife, husband, whatever. Pacing issues, just had a really bad day. You just don't know. When it comes to one individual person, one individual stock, there are so many things that could impact it positively or negatively. So the prediction is tough. Variations are much larger. Uncertainty is there as well. But when you zoom out and you try to pick the performance of 1,000 runners, it gets to be much easier. The odds of 1,000 runners all having stomach issues, all having bad days. And when you pull up the data from some of these races, as I did years ago, or when I look at some of the stats from my son's race, the field smooths out, the variance, the distribution smooths out, becomes very predictable. If that particular race has a really hot day, could all the runners do worse? They could. But even then, if you do multiple races, it evens out. There's always there's always things that could impact it based on if the race changes its entry policy and so forth, but you get the idea. That's how diversification works. A portfolio with 1,000 companies is much more predictable, or even a few hundred, than one company. As a dad, I was rooting for my son as I watched the Twin Cities Marathon, but as an investor, I really don't root for one runner. I invest in the whole field or a large part of the field. I do that because honestly, it's the best thing for my clients. Going back to Bloomberg, the main question that I offered in Bloomberg was, for most of your long-term money, the question really isn't, will I nail Nvidia? Will I get in and get out, especially when valuations are high? But what you should be asking is, can I get the return I need to reach my goals without swinging for the fences on one stock? And that's at the heart of investing, really. And some of you might be saying, well, I don't mind taking on that risk. And if you are in your 20s, 30s, 40s, question whether you want to do that in your 50s, it becomes a different scenario. Partly because, one, you don't have human capital, you're not buying in at the dips, but you're taking withdrawals. And if you're taking withdrawals, you are forced to sell to maintain a standard of living. And again, we use things like, and that's where we certainly use things like fixed income, other assets, emergency funds, and so forth. But when you're talking about that kind of concentration risk in individual stocks, those downturns, or I'll use a company that my father and grandfather were both JCPenney men. As I got into the industry, I remember talking to them and saying, you guys have a lot of concentration risk. You have a lot in this penny stock. And the response is one I've heard a lot since over the last 20 plus years, 25 years or close to it, was JCPenney's not going anyplace. JCPenney is an American institution. They're in every small town. Nothing can happen to JCPenney. I'm certainly not saying Nvidia is JCPenney. As the Bloomberg article points out, Nvidia has great growth, great earnings, but at some point, the price you pay for those earnings become an issue. And can they keep it going? If things are priced to perfection, can they keep going? And even if they can, do you as an investor, especially a retiree, want to or have to or need to take on that risk? Especially once you start distributions. One way to think about it is process versus outcome. Successful investing isn't about guessing winners or how long can Nvidia do this, how long before other competitors come in. And again, Nvidia is a great company. How great Nvidia is isn't the point. It's about building a portfolio that has some level of predictability that supports your life and retirement. We're not chasing heroes, we are engineering outcomes. And again, if you want to chase heroes, especially when you're younger, that's great. I mean, be aware of the risks, especially if you have a family. But when you get into retirement, that's when most folks, even if they can, they don't want to, and it becomes more challenging when you have to take distributions. Again, you could have a fixed income bond or a fixed income and bond portfolio and an equity portfolio to help offset each other. You could even use different asset classes. But when you're talking about concentration risk, you can't have such extended periods, especially if you're talking one company, a few companies, or a sector. And some companies do, like JCPenney, in essence, disappear. Now, Nvidia is a long way from that, but could you have a lost decade for an individual company? Absolutely. Absolutely. It doesn't have to be a tech company. I think Walmart was one where it was Wall Street's favorite. It was they priced in a lot of growth, and Walmart didn't do a bad job, but at some point it grows into that valuation, and then it's natural. Maybe it stalls out where it just you get so big that you can't grow anymore. You did what you were supposed to. Your earnings met that the projected price target, but then that new projected price target had to stay the same or maybe go lower because you just couldn't grow anymore like you used to. So as I tell a lot of clients, and as I told Bloomberg, so yes, feel the FOMO. Embrace the FOMO. Embrace the fear of missing out. This is like being in any relationship. Embrace the warmth, embrace the grief, acknowledge your feelings. They're natural. Don't shame yourself for it. If someone breaks up to you, don't shame yourself that you really like. Don't shame yourself for feeling that way. Give yourself, but then you got to pick yourself up and move on. In the case of FOMO, acknowledge it, embrace it. I just saw a piece by Matthew McConaughey that said, give yourself a day to feel sorry for yourself. Or to acknowledge that feeling. That seems like too short. In the case of FOMO, acknowledge it. It's real. Even some level of grief that maybe you didn't do. You shouldn't be keeping up with the Jones or trying to keep up with the Joneses, but acknowledge it. But then step back and let your plan drive the decisions, not the feeling. Step back and say, this isn't my goal. This is not the relationship I want. This FOMO is not a healthy relationship. This concentration risk is not a healthy relationship. The girl, the boy I just broke up with was not a healthy relationship. I need to grieve, but have gratitude in knowing that you have a plan. And the FOMO around an individual stock was not the plan. And those of you who have ridden this Nvidia wave and have done really well, if you're within 5 or 10 years of retirement, but especially 3 to 7, then consider reducing single stock exposure. If you're one of the passive investors who has everything in the S&P 500, consider international diversification. Bloomberg's article mentions something like that. International stocks have become more attractive when you start looking at not just valuations, but even some of the growth given the valuations, which that had been an issue. And they, I think it's clear, especially in Europe, they have some structural things. They certainly are less tech driven, which when you're talking 20, 30 years could hold you back. But as we've talked about many times, even without this kind of a new paradigm, international seems to have more of a catalyst now, even without that, because you don't know how quickly it can happen or when it's going to happen. Having some level of international exposure when you're in retirement to make those return sequences more predictable. You're going to have sequence of return risk, which is a fancy term in my industry, just saying, especially right before retirement, or right after retirement. If you have a bad sequence of returns right after retirement, that's where you have longevity risk. When you're talking about equities, the growth is always so high if things are planned for, especially if you use something like our dynamic green light distribution or green light withdrawal plan, dynamic distributions. The really main risk is when you have a downturn right after retirement, because if you do give those equities time to grow, the assets grow so high relative to expenses that then the rest of the time frame is satisfied. So, and that's sequence of return risk is a big issue, but it's even a bigger issue when you're talking about individual stocks. So, matching that asset allocation to life stage. When you're younger, take on more concentration risk. Just invest in the U.S. if you want. Don't really recommend doing completely that. Invest just in the semiconductor space. Again, be careful. You have time to take on that risk, time for large swings, but especially as you get closer to retirement, you need more diversification. You need more predictable returns. Remember, you don't have to get every decision right. You don't have to pick that hot stock. You're busy living life, not just your job, your family, your hobbies, whatever, pickleball, golf, running, whatever your hobby is. You shouldn't be having to be worried about what the hot stock is. If you nail the hot stock, where to get out, or like now, many people, like in the Bloomberg article, where to get in. At what point do you buy? If you're trying to get back in, at what point do you buy Nvidia? So it becomes a very, very complicated, and there's, especially in the short term, there's so much emotion, and now you're dealing with short-term options which drive the short-term markets. You're dealing with more retail traders. You're dealing with computers. You're quant trading, algorithmic trading. So there are so many things that trying to time these short-term stuff is stress you probably don't need, even if you're younger, but especially when you're in retirement. So feel free. We have links to our website if you do want to talk more about your concentration risk, even if you're in a general passive index type situation. Especially if you're near in retirement, reach out for our free retirement review. and we will help you take a look. Thank you for watching, and thank you, Bloomberg, for having me again. I love their stuff. They really do make an effort to educate and inform, and I'm happy to be a part of that. And even though it's been at least 6, 7, 8 weeks, congrats to my son. Congrats to Joseph on his first marathon. Even though he was probably more of a 3.5-hour marathon when he was 15 or 16, he was very happy to keep it under 4 hours. So it's been an impressive journey, and given everything else, I'm proud of him. Proud of him that he had such a good day. Proud of him that he had such great perspective, and feel gratitude that we were able to do things like that. That we could take time to run 4-hour marathons. So it's about effort in trying to finish strong, whether it's a goal like a marathon or financial planning or investing or retirement. So if you do take a little thought into your emotions, things like FOMO, and how diversification can help you in retirement, you're probably going to have a healthier, a wealthier, and a happier retirement. Don't forget to hit subscribe. Thanks for tuning in. If you enjoyed this episode, make sure to hit subscribe, leave a review, and share with your friends. Share the love. Make sure they have a healthier, a wealthier, and a happier retirement as well. Also, don't forget to subscribe to our newsletter for free resources, and check out our website and social media pages for exclusive content and updates. See you next time.
Sona Financial, LLC, DBA Sona Wealth and Sona Wealth Advisors, is a registered investment advisor with the state of Minnesota. All views, expressions, and opinions included in this communication are subject to change. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services. Any information provided has been obtained from sources considered reliable, but we do not guarantee the accuracy or completeness of any description of securities, markets, or developments mentioned.